I wish this was a calm holiday update. I really do. I was sitting there, screens off, trying to ignore the markets like everyone else. Western desks are closed. Volume is supposed to be dead. December 25th is supposed to be quiet. But I wouldn't be recording this right now if something serious hadn't just happened. Because while the US markets were closed, while traders were drinking eggnog and assuming nothing could move, the silver market already moved. Not on a chart, not on Twitter, in the physical market. Look at the numbers coming out of Asia. Silver in Shanghai just settled near $80 an ounce. At the same time, the price on your US trading app is showing roughly 72. That's not noise. That's not a rounding error. That's an $8 arbitrage gap in a market that is not supposed to have gaps at all. In a normal world, this wouldn't exist for more than minutes. Banks would buy silver where it's cheap, move it, sell it where it's expensive, and the gap would disappear. But that's not happening. And when arbitrage stops working, markets don't stabilize. They fracture. This isn't a prediction. This is math. Shanghai is the largest manufacturing hub on the planet. It's where silver is actually used. Solar panels, EVs, batteries, electronics. New York trades paper promises. And right now, the place that needs silver is pricing it far higher than the place trading paper claims. That tells you something uncomfortable. It means the metal isn't moving. Or worse, it isn't there to move. Because if New York silver were real and freely available, the banks would already be flying it east for a risk-free profit. They aren't, and that's why this matters. Now we need to talk about timing, because this didn't happen randomly. We are entering what traders call Ghost Week, the stretch between December 26th and January 2nd. This is the thinnest trading week of the entire year. Senior risk managers disappear, liquidity providers pull back. Institutional desks flatten exposure, market makers go offline. What's left are skeleton crews and algorithms. This does not reduce risk. It removes shock absorbers. In a liquid market, large orders get absorbed. And in a liquid market, even small orders can cause violent moves. Think of it like this. A crowded stadium absorbs noise. An empty gym echoes every sound. That's Ghost Week. Now layer this on top of the Shanghai COMEX gap. Silver in Asia near 80. Silver in the West near 72. Textbooks say arbitrage closes gaps. Reality says arbitrage creates stress when metal cannot arrive fast enough. And that's what's happening now. Asian industrial demand doesn't care about your technical indicators. Solar manufacturers don't wait for pullbacks. EV supply chains don't sell the rally. They secure material at any price. And here's the dangerous part. While the paper market is thin, the physical market is closing. Dealers are pulling inventory. Websites are showing delays and sold out banners. Not because of Christmas, because of risk. If you sell metal today at 72 and the price gaps to 80 when markets reopen, you can't restock. So the rational move is to stop selling altogether. That's how physical supply disappears before the chart reflects it. This is why Ghost Week is famous for gaps that don't fill. They explode. And that's why this $8 gap isn't shrinking. It's pressurizing the system. Now let's address the question every professional trader is asking right now. If silver is $8 cheaper in New York than in Shanghai, why isn't arbitrage fixing it? Because arbitrage only works when metal can actually move. On paper, the trade looks obvious. Buy silver in New York at 72. Ship it to Shanghai, sell it near 80, lock in risk-free profit. But here's the reality no one wants to say out loud. The metal isn't flowing. Either it isn't available, or the logistics chain is already stretched beyond its limit. And this is where the situation turns from interesting to dangerous. Because arbitrage is not just a trading strategy, it is the pressure valve that keeps global markets stable. When arbitrage breaks, markets stop communicating with each other. Price discovery fractures. What we are seeing now is not a temporary dislocation. It is a structural divergence between paper pricing and physical reality. And the banks know it. That's why they aren't stepping in. Because if they buy paper silver in New York and cannot secure delivery, they don't make money, they inherit risk they cannot hedge. That's why this gap exists during a holiday. Because risk managers understand something retail traders don't. Holding a short position into an illiquid holiday window, with physical demand exploding overseas, is a career-ending mistake. So instead of fixing the gap, they're backing away from it. And when the institutions that normally stabilize markets step aside, price doesn't move logically, it jumps violently. This is how broken markets behave. Now here's where people get confused. They hear the word crash and think price is going down. That's not what this is. A real silver market crash doesn't look like falling prices. It looks like prices you cannot buy at. It looks like charts freezing while physical markets move without them. It looks like dealers closing, inventory disappearing, and premiums exploding. It looks like two prices for the same asset, one real, one imaginary. And we are dangerously close to that line. Because when Shanghai is pricing silver at 80 and New York is pretending it's 72, someone is lying. Either the East is overpaying or the West is underpricing something it cannot deliver. History tells us which one breaks first. Paper promises always fail before physical demand does. And once confidence cracks, it does not come back smoothly. It snaps. That's why this week matters. Ghost Week removes liquidity. Asia adds demand. Arbitrage fails. Physical supply tightens. That combination doesn't create orderly pullbacks. It creates gaps. And gaps don't negotiate. Now listen carefully, because this part matters more than price. This is not about chasing silver higher. This is not about predicting 80, 90, or 100. This is about market structure. What you are watching right now is a system under stress. Not collapsing, but bending. Paper markets still exist. Charts still update. Trades still clear. But beneath the surface, trust is thinning. Traders are demanding delivery instead of cash. Premiums are rising to escape paper exposure. Asian buyers are paying up without hesitation. These are not emotional reactions. They are rational responses to scarcity. And scarcity does not announce itself with headlines. It shows up in spreads, gaps, delays, and silence. Silver is not predicting the future. It is revealing the present. And markets that reveal truth early are always ignored. Until they can't be. This is not a normal rally. This is not speculation. And this is not a sudden collapse. What you're watching is a stress reveal. Financial systems don't break instantly. They leak first. They leak through price gaps that shouldn't exist. They leak through delivery demands that overwhelm supply. They leak when arbitrage simply stops working. That's what silver is doing right now. When Shanghai pays nearly $80 for physical silver, and New York defends the low 70s on paper, this isn't disagreement. It's two realities. One based on availability, the other based on assumption, and assumption always loses. This doesn't mean silver moves straight up. It means volatility increases. Stable systems don't behave like this. They don't fracture regionally. They don't force traders to pay extreme premiums to escape paper exposure. Those are signs of pressure. Pressure exposes trust. Trust that paper silver can be delivered. Trust that inventories are real. Trust that price reflects reality. The trust is thinning. Silver isn't predicting the future. It's reacting to the present, faster than narratives can adjust. This isn't financial advice. It's a signal. And signals matter most before headlines catch up